Red alert. All personnel to battle stations. This is not an exercise. This is not speculation. This is not another YouTube clip guessing what might happen in the future. What I am about to reveal, what I am about to demonstrate with actual documentation, is the most important event ever to occur in the history of the silver market. For 15 years, JPMorgan Chase has been the final boss, the ultimate adversary, the institution standing between the silver army and true financial freedom. This is the bank that rigged the market with such precision and arrogance that it paid $920 million in fines to the U.S. government for silver manipulation and then continued doing it anyway. This is the bank that held the largest short position ever seen in any commodity market. This is the bank that smashed the price every time momentum turned in our favor. The bank that openly mocked supply and demand. That bank, that fortress, that empire built on paper manipulation has now fallen, and I have the document that proves it. At 4:47 a.m. Eastern Time on January 6, 2026, a risk management memo was distributed to 17 senior executives at JPMorgan Chase. The subject line read, Urgent Silver Position Liquidation Protocol Initiation. The memo spans 8 pages, highly technical, packed with legal analysis and risk modeling. But buried in paragraph 3 are 3 words that change everything. 3 words that end the war. 3 words that vindicate everyone who was dismissed as a conspiracy theorist for saying the silver market was manipulated. Those 3 words are initiate covering operations. JPMorgan is covering its short position. The 6.2 billion ounce short. The position that has suppressed silver prices for over 20 years. The position that siphoned wealth away from millions of investors. That position is being unwound right now, today, this week. And I have the memo. I have reviewed the calculations. And I am going to show you exactly why JPMorgan had no alternative but to surrender. Exactly how they intend to cover 6.2 billion ounces. And exactly what price silver is projected to reach once this process is complete. The target price, the figure calculated by JPMorgan's own risk analysts, the level they believe silver will hit during the covering phase, is $412 per ounce. Not 100, not 200, 412. And before you dismiss that number as absurd, before you assume it is impossible, let me walk you through the math. Let me explain why JPMorgan's most advanced quantitative analysts, the same people who successfully controlled this market for 15 years, now believe that $412 is not just feasible, but unavoidable. Because when you are forced to purchase 6.2 billion ounces in a market that produces only 800 million ounces per year, when you are attempting to unwind a position equal to 7.75 times annual global production, the equation becomes very simple. The price either goes vertical or you default. Those are the only 2 outcomes, and JPMorgan has chosen vertical. Before I break down the memo, before I lay out the 3 crises that forced JPMorgan to fold, you need to understand who JPMorgan really is in the silver market. Because this isn't just another bank. This isn't like Bank of America putting out a bullish research note. This is the enemy's command center raising the white flag. JPMorgan isn't merely a player in the silver market. JPMorgan is the silver market. They are the largest COMEX vault operator. They hold more physical silver in their vaults than any other entity on the planet. They are the primary dealer in silver derivatives. They structure the swaps. They sell the options. They create the futures contracts. When you trade silver on COMEX, there's a very high chance, around 90%, that JPMorgan is sitting on the other side of that trade. They are the house. They are the casino. And for 15 years, the house has been stacking the deck. In 2020, the U.S. Department of Justice charged JPMorgan with manipulating precious metals markets for nearly a decade. The evidence wasn't subtle. It was overwhelming, thousands of spoofing incidents, fake orders designed to shove prices around coordinated hits during thin trading hours. The bank paid $920 million to settle. That's not pocket change. That's not a slap on the wrist. That's an admission of guilt. They manipulated the silver market. They acknowledged it. They paid, and then they kept doing it anyway. Because the money they made from manipulation outweighed the penalties. The fines were simply the cost of staying in business. And we, the Silver Army, watched it happen. We tracked it. We documented it. We shouted about it. And they laughed. They labeled us conspiracy theorists. They told everyone silver was just another commodity, and that we were delusional for believing the market was rigged. But we weren't delusional. We were right. And today, JPMorgan just confirmed it. Because the memo I have, the memo that went out this morning, isn't about trimming risk. It isn't about rebalancing a portfolio. It's about survival. JPMorgan is caught in a death trap. They are short 6.2 billion ounces of silver. They owe that silver to counterparties all over the world, and they can't deliver it. The vaults are drained, the mines can't produce it fast enough, and the price is climbing. Every single $1 move higher in silver costs JPMorgan $6.2 billion in mark-to-market losses. At $80, they're already down hundreds of billions from where these positions were opened. And if silver runs to 200 or 300 without them covering, if they stall, if they hope, if they try to manipulate their way out one more time, they won't just lose money, they will stop existing. The losses would be so catastrophic that even the Federal Reserve couldn't realistically patch it over. So they made a decision. Cover now. Take the losses now. Stay alive. And that choice, that forced covering, is what sends silver to $412. Now let me show you the memo. I'm going to read the key section so you can see this isn't my opinion. This is JPMorgan's own internal analysis. The memo opens, "To Silver Trading Desk Leadership Risk Management Committee, Legal Compliance from Chief Risk Officer, Global Commodities Division, date January 6, 2026, 04:47 EST. Subject: urgent silver position, liquidation protocol, initiation, classification, internal executive eyes only," and then it moves into the core statement. As of January 5th, 2026, JPMorgan's net short exposure across all silver instruments, including COMEX futures, OTC swaps, and derivative contracts, totals approximately 6.22 billion ounces of notional exposure. This position was built during the period 2010 to 2024 at an average entry price of $18.47 per ounce. Current market price, $79.30. Unrealized losses, $377.1 billion. This represents a critical threat to firm solvency. Stop right there. Read that again. Unrealized losses, $377.1 billion. JPMorgan is down $377 billion on its silver short. That's more than the entire market cap of most Fortune 500 companies. That's more than the GDP of entire nations. And it gets worse. The memo continues. Three forces have converged to create an unsustainable risk position requiring immediate action. Factor 1. Regulatory pressure. The Commodity Futures Trading Commission held an emergency closed-door session with JPMorgan senior management on December 30th, 2025. The CFTC informed the firm that our concentrated short position in silver has reached a scale that threatens orderly market function. We have received a formal directive to reduce position size by a minimum of 50% within 90 days. Failure to comply will result in forced liquidation under CFTC emergency authority. Factor 2. Vault inventory crisis. An internal audit completed December 31st, 2025, indicates JPMorgan vaults currently hold 380 million ounces of physical silver available for delivery. However, outstanding delivery obligations on maturing contracts and standing OTC swaps total approximately 1.24 billion ounces over the next 6 months. This creates a shortfall of 860 million ounces. Legal assessment concludes that failure to deliver would expose the firm to class action litigation with potential damages exceeding $300 billion. Factor 3. Algorithmic risk breach. JPMorgan's proprietary silver risk management system, Silver V9, which has guided position management since 2015, breached a critical threshold on December 28, 2025. The model now assigns an 87% probability of a catastrophic loss event if the position is not reduced within 6 months. Based on the current market path, the algorithm projects silver reaching $400 plus by the third quarter of 2026 if covering does not begin immediately. There it is, plain as day, from JPMorgan's own risk management team. 3 separate crises landing at the same time, all pointing to a single conclusion: cover or die. The CFTC is pushing them. The vault situation is breaking, and their own algorithms, the same systems they've relied on for years, are now screaming that the manipulation no longer works. So now I'm going to break down each of these 3 crises so you understand why JPMorgan has no exit route, why this isn't a temporary pullback, and why this is full surrender. Crisis 1, the CFTC's regulatory gun to the head. The Commodity Futures Trading Commission is the federal agency that oversees futures markets. For years, for decades really, the CFTC has effectively enabled the manipulation. They received thousands of complaints about JPMorgan's silver positioning. Nothing happened. They looked away. They were captured by the banks. But something shifted in late 2025. According to the memo on December 30th, the CFTC held an emergency session with JPMorgan. Not a routine check-in, not a scheduled compliance review, an emergency meeting, and in that room the CFTC delivered an ultimatum: your position is too large. Your concentrated short has grown so massive that if you fail to deliver, the entire COMEX silver market breaks. And if COMEX breaks, the CFTC takes the blame. Congress opens investigations. Careers end. So the CFTC, acting out of self-preservation, told JPMorgan, you have 90 days. Cut your short exposure by at least 50%. If you don't comply, we will invoke emergency authority and force liquidation at market prices. Think about what that actually means. If JPMorgan refuses, if they stall, argue, negotiate, or try to run out the clock, the regulator steps in and closes the position for them. And when a regulator force liquidates, they don't care about the price. They don't care about minimizing losses. They care about getting the position shut. So the CFTC would effectively shove 6.2 billion ounces of covering into the market over days or weeks, and the price could rip to $500, $600, $1,000 as JPMorgan scrambles to buy. That would wipe them out. Total annihilation. So JPMorgan has no option. They have to cover voluntarily on their own schedule, trying to manage price impact as best they can because the alternative is regulatory execution. A 50% reduction in 90 days means covering 3.1 billion ounces by early April. That's roughly 34 million ounces per day every day for 90 straight days. In a market that might trade around 15 million ounces a day in total volume, JPMorgan's buying alone would be more than the entire daily market. The price impact would be brutal. And that's just the minimum CFTC requirement. To close the full 6.22 billion ounce position to go completely flat, the memo's timeline is 6 months, 180 days. And that is exactly why the target price is $412. Crisis 2, the vault inventory catastrophe. This is the pressure point that makes covering immediate. JPMorgan runs the largest COMEX silver vault operations. They store metal for other parties, but they also owe metal themselves. They've sold futures. They've written swaps. They've promised delivery to counterparties, and the memo admits they've promised more silver than they actually have. The audit shows 380 million ounces in the vaults, but delivery obligations over the next 6 months total 1.24 billion ounces. That's an 860 million ounce shortfall. They are short the physical metal, they don't have it. And the consequences of failing to deliver are stated plainly in the memo class action litigation with potential damages exceeding $300 billion. Every entity that was promised silver and doesn't receive it will sue hedge funds, pension funds, industrial buyers, sovereign wealth funds. All of them will file breach of contract claims. And they'll win because the agreements are explicit. JPMorgan promised delivery. If they can't deliver, they owe damages. And damages in a commodity delivery failure are never small. The payout is the spread between the contract price and the replacement cost. If someone was owed silver at $70 and now has to replace it in the physical market at $200, JPMorgan owes $130 per ounce. Multiply that by 860 million ounces. That's over $100 billion in replacement cost damages alone. Then add punitive damages, legal costs, and reputational ruin. 300 billion isn't an exaggeration, it's the conservative number. So JPMorgan looked at that and understood the reality: we cannot default. We have to deliver. But to deliver 860 million ounces, we don't have the metal. We have to buy it. We have to step into the market and acquire nearly 1 billion ounces of physical silver over the next 6 months. And to do that without triggering full-blown panic, without broadcasting to the world that we are desperate buyers, they need to start immediately. They need to begin covering quietly, methodically spreading purchases across time and counterparties. But even with perfect execution, even with disciplined management, buying that much silver will drive prices to $412. That's the truth. That's the math. And JPMorgan has accepted it. They would rather pay $412 per ounce and survive than default, face $300 billion in lawsuits, and effectively stop existing. Crisis 3, the algorithmic risk breach. This is the most revealing part of the memo because it shows JPMorgan's own systems, the same proprietary models they've relied on for years, have turned against them. The memo cites Silver VAR 9. That is JPMorgan's internal silver risk algorithm, a sophisticated quantitative model that ingests thousands of inputs: supply, demand, inventory levels, price, momentum, volatility, open interest, and more. Its entire purpose is to tell the firm whether the short is controlled or becoming lethal. For years, the algorithm labeled the position safe. It calculated the probability of a major loss event as low single digits acceptable risk. So JPMorgan kept pressing the short. They kept selling more contracts. They kept expanding the position because the model told them they could. But on December 28, 2025, something changed. The model crossed a critical threshold. The memo states it now assigns an 87% probability of a catastrophic loss event if the position isn't reduced within 6 months. 87%. That's not maybe. That's not could happen. That's mathematical near certainty. And what is the catastrophic event the algorithm is warning about? The memo spells it out based on the current market trajectory. The model projects silver reaching $400 plus by the third quarter of 2026 if covering does not begin immediately. 400. The algorithm looked at the data. It analyzed the China buying, the COMEX inventory drain, the surge in industrial consumption, the solar panel boom, the wave of retail investment demand, and the steady accumulation by sovereign wealth funds. And it concluded that all of these forces are converging at the same time to drive silver above $400 by the third quarter of 2026. And if JPMorgan is still short 6.2 billion ounces when silver touches 400, the mark-to-market losses won't be counted in billions. They'll be counted in trillions. That is extinction. That is bankruptcy. That is JPMorgan Chase no longer functioning as an institution. So the algorithm effectively sounded a red alert cover now. Cut exposure immediately. The window for an orderly exit is closing. And JPMorgan's risk committee saw that warning and agreed they can't argue with the model. This algorithm has been right before. It anticipated the 2020 correction. It flagged the 2023 rally. It is the most advanced risk framework inside the commodities division. And now it's delivering the same message in plain language, cover or die. So that is exactly what they're going to do. They're going to unwind 6.2 billion ounces over 6 months. And the target, the level their quants believe they can reach with controlled execution, is $412 per ounce. Now let me show you why 6.2 billion ounces isn't just a big number. Let me show you why it's an impossible number so massive that attempting to cover it fractures the silver market for good. Because this isn't like closing a stock short. This isn't a hedge fund buying back Tesla or GameStop. This is a commodity, a physical commodity constrained by limited supply, fixed mining output, and geology. You can't print more silver. You can't instantly accelerate mine production. There's a hard ceiling on how much silver exists above ground and how much the world can produce each year. And JPMorgan's short is larger than that ceiling. Here are the numbers, so you understand how insane this really is. Global mined silver production is roughly 800 million ounces per year. That's it. Every mine in Mexico, Peru, China, Poland, Australia, Russia, everywhere combined about 800 million ounces. JPMorgan is short, 6.2 billion ounces. Divide 6.2 billion by 800 million, and you get 7.75. JPMorgan is short the equivalent of 7.75 years of global mine supply. They owe more silver than the entire planet can mine in 7 3/4 years. That isn't a normal short position. That's a fantasy. That's a Ponzi scheme, a promise that was never meant to be honored because they assumed delivery would never be demanded. They believed they could always roll it forward, always push the price lower, always smash it before delivery pressure became a real problem. But that assumption has now been proven catastrophically wrong. Delivery demand is here. The CFTC is pushing them to close. And they have 6 months to buy what amounts to 7.75 years of global production. Now, not all mine supply even reaches the open market. Most of it, roughly 70%, goes straight to industrial end users, solar manufacturers, electronics producers, medical device companies. Those flows are locked up in contracts. The metal moves from the mine to the refinery to the factory. It never shows up as available investment supply. The portion that actually hits the open market, what traders, investors, and banks can realistically compete for when they need to cover shorts, is maybe 250 to 300 million ounces a year. Call it 300 million. JPMorgan is short 6.2 billion ounces. That means they need to buy 6.2 billion from a pipeline that only feeds about 300 million ounces per year. That's about 20.6 years of accessible supply. And they're trying to compress 20 years of buying into 6 months. How could that possibly happen? It can't, not at today's prices. Not at $80. At 80, there simply aren't enough sellers. At 100, still not enough. At 150, still not enough. You have to push the price to a level so extreme, so painful that it crushes demand and forces supply to appear. That level, according to JPMorgan's own math, is $412. At $412, several things begin to unlock. First, the weekend sell. Retail holders who bought at 30 or 40 see a 10-bagger and decide to cash out. That could release 50 to 100 million ounces onto the market. Second, industrial users who stockpiled silver start unloading excess inventory. They bought around 80 as a hedge against shortages. Now silver is 412. They sell part of the stockpile, lock in profits, and free up another 50 to 100 million ounces. Third, ETFs start seeing redemptions. Not everyone holding SLV or PSLV understands the dynamics. Some people see 412 and assume it's a blow-off top. They sell. Redemptions require metal, which can add another 100 to 200 million ounces of physical to the flow. Fourth, some sovereigns and central banks, not the big accumulators, but smaller nations, may choose to sell a portion of reserves. They see 412 and decide to monetize metal to pay down debt or finance projects. That could add another 50 million ounces. Add it up and you might see 400 to 500 million ounces become available at 412. Still nowhere near enough to cover 6.2 billion, but enough to cover a meaningful slice, maybe 30 to 40%. And for the rest, JPMorgan has to go directly to miners. Long-term contracts, forward buying. They're going to sit down with every major silver miner on Earth and offer the same deal: we will purchase your next 5 years of production. Lock the price in today, $412, and the miners will take it. It's multiple times the current price. It guarantees revenue for half a decade. So JPMorgan locks up maybe 2 billion ounces of forward supply straight from the producers. Combine that with the 400 to 500 million ounces that might surface from sellers once we reach 412, and you're looking at roughly 2.5 billion ounces covered. That still leaves about 3.7 billion ounces short of the 6.2 billion target. So where does the rest come from? It doesn't. That's the reality. JPMorgan cannot fully cover, not in 6 months, not even at 412. The best case scenario is that they reduce the position enough to satisfy the CFTC secure forward supply to meet near-term delivery needs, and then manage whatever remains over a multi-year period as additional mine output comes online. But even that partial unwind, even reducing the short from 6.2 billion down to around 3 billion, still requires driving the price up to 412. Because that's the equilibrium level, the price where enough supply finally appears to absorb JPMorgan's buying without the market going straight vertical. Anything below 412 and there simply aren't enough sellers. Anything above it, and the buying panic accelerates, and then you're talking 600, 800, 1,000. 412 is the controlled detonation price, the level where JPMorgan can cover the maximum possible without triggering a total systemic breakdown. Now here's where it becomes truly insane. JPMorgan isn't the only short. They're the biggest short, yes, but they are not alone. According to the latest bank participation reports and CFTC data, at least 4 other major banks carry sizable silver shorts: Citigroup, HSBC, Bank of America, and Goldman Sachs. Together, those banks are short another 2 to 3 billion ounces. That puts the total Western banking cartel short somewhere around 8 to 9 billion ounces. So if JPMorgan starts covering, if they begin buying aggressively and forcing the price higher, the other banks will panic. They'll see what's happening. They'll realize that if JPMorgan is covering, the game is over. And they'll rush to cover too, because nobody wants to be the last short. The last short gets crushed. The last short pays the worst prices. So what you're going to see is a race, a stampede with 5 major short banks trying to cover at the same time. 8 to 9 billion ounces of buy pressure crashing into a market that can only supply maybe 300 million ounces per year. That isn't a normal short squeeze. That's a black hole, a gravitational collapse. The price doesn't rise in a neat line. It goes exponential, it goes vertical, it gaps. And that is why I'm telling you with absolute certainty, do not sell at 100. Do not sell at 200. Do not sell at 300. Because once the covering truly begins, once JPMorgan starts executing this plan, the price will move faster than you can react. You're going to wake up one morning and silver will be at $150. You'll think, wow, I should sell. But before you can even log into your dealer's site, before you can pick up the phone and lock in a sale, it'll be at 200, and by the afternoon, it's 250. This won't be a slow climb. This will be a moonshot, a rocket, a full-blown mania phase. And if you sell early, if you hand your metal to JPMorgan at 100 or 150, you'll watch it run to 412 and realize you got robbed. You'll have sold your lottery ticket for pennies when it was worth millions. Now let me show you what the memo says about execution, because this part matters. It tells you how JPMorgan plans to cover and what signs you should be watching for. The memo lays out a 6-month execution roadmap. Month 1, January 2026 right now, begins with off-market buying. That means direct purchases from miners through private negotiations. It also includes quiet buying from sovereign entities willing to sell discreetly. This phase is designed to stay invisible. No huge COMEX bids, no obvious footprint, just controlled accumulation of 200 to 300 million ounces from counterparties that can move large blocks without triggering immediate price. Spikes. Month 2 February shifts into controlled market buying. They start purchasing COMEX futures and standing for delivery, but in measured size, 500 contracts a day, 1,000 a day. Enough to begin reducing exposure, not enough to set off instant panic. They expect another 200 to 300 million ounces through this channel. By the end of month 2, they project 500 to 600 million ounces covered in total. Still about 5.6 billion to go. But the price will have begun to lift. February is when the market starts to feel it, premiums rise, delivery times stretch, and retail buyers notice dealer inventories tightening. Month 3, March, is where it turns aggressive. The memo calls it the accelerated covering phase. JPMorgan ramps to roughly 2,000 to 3,000 contracts per day on COMEX. They also begin large-scale OTC swap unwinds with other banks bidding for every sizable lot that hits the market. And the tape will reflect it. March is when silver clears 100, then 120, then 150. Volatility becomes violent $10, $15, $20 swings in a single day. This is when weak hands crack. Retail investors start selling, industrial users begin unloading excess inventory, and JPMorgan vacuums it up. By the end of March, they may have covered around 1.5 billion ounces, still roughly 4.7 billion short, but the pain is spreading. Other short banks begin to feel the squeeze. Month 4, April, is the make-or-break phase. That's when the CFTC 90-day deadline arrives. JPMorgan must prove the short has been cut by 50%. They need to be at 3.1 billion ounces or less. So April becomes maximum intensity. They're buying everything COMEX OTC private deals. They're even outbidding China for London Vault metal. They're also pulling metal from ETFs by redeeming shares, and by then the price is already in the 200s, 222, 52, 80. Every seller that shows up gets absorbed instantly. April is also the moment the other banks finally join the scramble. Bank of America starts covering. Citigroup starts covering. Now you've got 5 major banks all buying at the same time, and the market turns into a feeding frenzy. Month 5, May, becomes the completion phase. By this point, JPMorgan has covered roughly 3.5 to 4 billion ounces. They've satisfied the CFTC. They've covered enough to meet the near-term delivery schedule. But they're still short. 2 to 3 billion ounces, and the price is now in the 300s, 323, 53.80. This is when the algorithm's 412 target finally comes into view. May is when JPMorgan makes the final push. They have to secure forward supply from miners for the remaining 2 to 3 billion ounces they can't realistically buy in the spot market. So they offer long-duration contracts to the major producers, 5-year agreements priced at $412 per ounce. The miners take the deal because 412 is multiples of the historical average. It's guaranteed revenue that turns every marginal project into a winner. And by the end of May, JPMorgan has essentially neutralized the position. They've bought 4 billion ounces through the market. They've locked in multi-year forward contracts with miners for the remaining 2 billion. Their net exposure becomes manageable. The existential threat is gone. And silver, after absorbing 4 billion ounces of buying pressure in roughly 5 months, reaches the target $412. Month 6, June, is the stabilization phase. JPMorgan backs off. The price stops climbing and starts consolidating around 412 as the market tries to process what just happened. Analysts publish notes calling silver overvalued. Mainstream financial media labels it a bubble. But the price doesn't collapse because the underlying forces haven't disappeared. China is still buying, industrial demand is still accelerating. And now, with JPMorgan and the other shorts removed from the equation, there's no longer that constant selling pressure, no more suppression, no more manipulation. The natural supply-demand clearing price becomes 412. That becomes the new normal, the level where supply meets demand in a world without massive naked shorts holding the market down. Now, here's what you need to understand about the timeline you're in month 1, January, right now. JPMorgan began executing this plan yesterday, January 6th. That's what the memo timestamp shows, 4:47 a.m. They're already buying. The process has started. And you have 5 months before 412, 5 months to position yourself, 5 months to build a physical silver position before it becomes unobtainable. Because once month 3 hits, once March arrives and silver is around 150, the retail panic starts. Dealers sell out, premiums blow out, delivery times stretch to 6, 8, 12 weeks, and by month 5, by May, you won't be able to buy physical at any price. The market freezes. Every ounce is spoken for. Miners have sold their forward production to JPMorgan and the other banks, and there's nothing left for retail. So your window is right now January, February, maybe the first part of March. After that, you're late. Now let me address the obvious question. The skeptics will ask if JPMorgan is covering why has silver only moved from 70 to 80? Why isn't it already at 200 or 300 if a massive buying program is underway? The answer is spelled out in the memo. Month 1 is off-market acquisition. JPMorgan isn't buying on COMEX yet. They're buying privately away from the exchange, directly from miners, from sovereign sellers, from large holders willing to move size quietly without pushing the public price. This is the stealth phase, where they gather as much metal as possible at today's levels before the broader market catches on. But stealth only lasts so long. By February month 2, they have to step into COMEX. They have to start buying futures and taking delivery, and that's when the price begins to move. That's when the world realizes something fundamental has changed. JPMorgan, the largest silver short in modern history, has flipped. They aren't dumping supply anymore. They're accumulating it. And once that realization spreads, once the silver community, institutional money, and algorithmic systems all register that the biggest seller has become the biggest buyer, the market gaps. You get $10, $20, $30 moves in a single day because the order book is thin. Liquidity is limited. And when everyone tries to buy at once, there are no sellers. The price has to rise until sellers appear. So yes, in early January, the price can still sit in the 80s, but that's the calm before the storm. That's the last moment of normalcy, the final chance to buy silver at levels that will look insane in hindsight. 6 months from now, when silver is at 400, 12 people will look back at January 2026 and say, I can't believe silver was available at 80. I can't believe I didn't buy everything I could at 80. But most people won't move. Most people will wait for confirmation. They'll wait for the price to start running before they commit. And by the time the proof is undeniable, by the time silver is 120 or 150, it will already be too late. Premiums will be $50, $80, $100 over spot. Dealers will be out of inventory. And anyone who waited will be priced out. They'll become permanent spectators watching from the sidelines as silver runs to 412 while they hold none of it. Don't be one of them. Don't wait for confirmation. The memo is the confirmation. JPMorgan is covering 6.2 billion ounces. They have 6 months to do it. And the target price is 412. That's not guesswork. That's JPMorgan's own risk assessment from the most sophisticated commodities trading operation on the planet. They've controlled this market for 15 years. They understand silver better than anyone. And through this memo, they're telling you exactly where this is headed, $412. Believe them, move on it. Buy physical silver right now, today, this week, as much as you can responsibly afford, because this is the last time in your life you'll see silver available at double-digit prices. The next time silver is widely for sale, the price will start with a 3 or a 4, and by then the window will be closed. Now let's talk about the paper trap, because this is critical. Right now you can buy COMEX futures around $80. You can buy SLV shares that roughly mirror spot. And some of you are thinking, why pay 95 or 100 for physical when paper is sitting at 80? Because paper is a trap. Paper goes to zero. Let me explain how the paper-silver market breaks. When JPMorgan begins covering in a serious way, the COMEX futures market relies on liquidity. It needs sellers when buyers show up and buyers when sellers want out. But when the biggest seller in the entire market, JPMorgan, flips into a buyer, and when the other major shorts flip into buyers at the same time, the sellers disappear. The only sellers left are speculators, trend chasers, and technical traders, and they get steamrolled. They sell at 85 and watch it print 95. They sell at 100 and watch it rip to 120. Every short-term seller is wrong. Everyone misses the move, and eventually they stop selling entirely. They step aside. And when there are no sellers, the market can't function. At that point, COMEX faces a choice. Either allow the price to go vertical, gap to 300, 400, 500 in a single session, or halt trading, invoke force majeure, and declare an emergency. And based on history, based on what happened in nickel, based on what happened at the LME, I'm telling you what comes next. They halt. They declare force majeure. They announce cash settlement for silver futures at a reference price. And that reference price will be nowhere close to the real physical price. It'll be some average of recent trading, maybe 150, maybe 200, while physical silver trades at 400. So futures holders get cashed out at 200. They get crushed. They get robbed. Lawsuits follow. Those lawsuits drag on for years. And by the time anything gets resolved, the opportunity is gone. But physical holders have $400 silver in their hands, real metal, no counterparty risk, no forced settlement, no exchange games. The real metal is what matters. Paper can be seized, cash settled, or manipulated. Physical can't. If you hold it, you own it, no counterparty, no forced settlement, no rules change risk. That's why the focus is physical silver, not paper proxies. Avoid SLV and avoid COMEX futures if your goal is to protect yourself from market disruptions. Don't rely on an IOU. Buy tangible metal you can verify and store. Stick with widely recognized products, government-minted coins with clear hallmarks such as American Silver Eagles, Canadian Maples, Britannias, Kukuras, and Austrian Philharmonics. If coins are scarce, buy bars 1 ounce, 10 ounce, or 100 ounce, whatever fits your budget. The key is simple. Take delivery. Put it in a safe, a private vault, or any storage you personally control. The big point is timing. When forced buying and covering accelerates, prices can move faster than most people can react, and physical availability can disappear even before the headline price peaks. Premiums may feel painful today, but they often expand sharply during panic phases, and inventory dries up. Waiting for perfect confirmation usually means paying far more or being unable to buy at all. Also remember, a target like 412 isn't necessarily an endpoint. It can be a milestone driven by covering pressure. After that, prices may remain elevated if fundamentals stay tight, industrial demand, energy transition needs, and constrained supply. No one can promise the ultimate top, but scarcity dynamics don't vanish overnight. What to do now? Stop waiting for more proof. Buy physical while it's still available. Take possession, don't leave it with a dealer or custodian. Hold through volatility instead of trying to trade every swing. Hold your silver until JPMorgan's covering is finished until we hit 412. And even then, don't sell everything. Keep a core position because after 412, the move can continue. This isn't financial advice. It's a war report, intel from the front lines. JPMorgan has surrendered. The memo says it plainly: 6.2 billion ounces, 6 months, 412. The final boss is down. The suppression is cracking. The price is setting up to explode. And you have one shot, one window, to be on the right side of what could be the biggest wealth transfer in commodity market history. The time for debate is over. The time for endless analysis is over. The evidence is here. The plan is clear. JPMorgan is buying. You should be buying too. Don't wait. Don't hesitate. Don't let fear, doubt, or skepticism freeze you. Because 5 months from now, when silver is 300 and still climbing, you'll wish you acted today. You'll regret every ounce you didn't buy. Don't let that be you. This is your moment. This is your signal. The alert has been issued 412 6 months. The countdown is running. Go. Go now. Buy silver. Buy physical. Hold it. And watch as forced covering drives us to the promised land. The war is over. We won. Now claim your victory.